Hello and welcome, I'm Suyash Maheshwari and you are watching Last Tick here on News9, where we bring to you the highlights of the day's action on the last week. Now, Indian markets witnessed its worst session so far in 2024 as the headliners corrected by about 1% in a day of broad-based sell-off. Now, Nifty gave up all that it had recovered in the Thursday and Friday session to end around the 21,500 levels, which by the way is also the closing levels of the Wednesday session. So pretty much everything that we recovered in the last two sessions, we lost it today. Sensex on the other hand gave up around 670 points to close just marginally above the 71,350 mark. Now this is the worst closing for the index since January 3rd. Which is also Wednesday. The sell-off today was not only limited to the headliners, but it was rather broad-based as we witnessed, a good correction in the mid-cap and the small cap segment too. Nifty mid-cap 100, for instance, gave up around 1% or so to end below the 47,000 point, just about 106 points lower. Whereas the small cap index, which by the way did scale a record high in opening trade today, settled about 0.62% lower at 15,342 mark. The volatility index also saw a sharp spike today. India VIX jumped over 7% to end at 13.52 levels. But despite the 7% or so jump in today's session, we are still below the 16 sort of levels that we had witnessed last week. So a big decline from there, but on a day-on-day basis, volatility has spiked up quite significantly. Moving on to sectors, all sectors barring media and realty settled in the red. FMCG counters as well as the banking and the financial names were the worst hit. Now Nifty Bank, for instance, corrected by about 1.5% or so, or about 700 points, to settle at its lowest level since December 20 of 2023. Of the 12 constituent stocks in the index, about 11 ended in the red and they corrected by somewhere around 1 to 8%. To understand what led to the market's correction, what led to this broad-based sell-off that we saw on Monday and more, let's bring on board Mr. Ambrish Balega, independent market expert. Hello Mr. Balega, thank you for joining us here on Last Tick. Alright, Mr. Balega is yet to join us, but let's expand on the correction that we saw among sectors. Nifty Bank, we have been hovering around that 48,000 levels for the last 3 weeks. The index had significantly overtaken those levels on Thursday and Friday's trade. We ended about 300 points higher above than that, and the expectation broadly was that 48,000 would now become a key support for the index. But in today's sell-off, where we saw big corrections in private banks as well as PSU banks, as you can see on your screen, they gave up around 1.5 to 2.5% or so, led to a broad-based correction in the banking pack, and they gave up around 1.5% or so. Among other sectors was Nifty IT. Now that corrected by about 1%. It was seen recovering some of those early year losses on Friday, but today we gave up all that we had recovered again over here, and the index settled about 1% lower. Now probably one of the reasons why we are seeing this sort of a correction in the market is that the market, if you remember, in November and December, once that narrative shifted from where it was being talked about that US might go for another rate hike in 2024, we had seen a big shift in that narrative, and there were now talks of US perhaps going for a rate cut as early as 24. But some of the Fed members have pushed back in the recent weeks, and they are pretty much saying that we still need to be cautious about this inflation situation that is playing out, especially in regard to the crisis that's going on in the Red Sea, which could drive up the shipping costs and logistics costs in general. So that could bring in inflation levels back to uncomfortable levels, which could perhaps push that interest cut that was expected for the session. So that's why I think the broad-based sell-off was seen not just in India but the global markets as well. If you look at the Asian markets, most of them settled with a loss of about 1.5% to 2% in today's session, and same story was seen in the Indian markets as well. And as I mentioned, we were tracking all the way Nifty's fall from Wednesday's high point to Thursday's low point, and the market had recovered most of it, but today we gave up all that we had gained in the last 2 sessions. But joining us live is Mr. Ambarish Baliga, independent market expert. Now, sir, not the best of starts to 2024. I think today was the worst session so far in the first 6 sessions of 2024. What do you think led to this price correction?
No, I mean, I think about a week back, we were discussing the same thing as to how 2024 would be. And I had clearly mentioned that making money in 2024 will not be as easy as it was in 2023. And if you look back at history, January has been a dull month mostly. And I mean, people were expecting that this time it could be different, looking at the way 2023 panned out. But then, I mean, basically, there's not much of a major positive news flow at this point of time. Valuations are very steep. And basically, I think the markets were just waiting for sort of a correction before the next major move, whichever way, whether it's up or down. So I think that's what exactly has happened now. I mean, we had seen a trailer of this a few days back when we saw a correction of 300 points, and then we saw the market bouncing back very well. But I mean, today's fall, I wouldn't say it's a very steep fall, but yes, I think it's a good correction, which I think was overdue. And I think it should correct a bit more before you'll actually see people coming in to buy.
All right. So, I mean, considering that, you for one has been a voice of caution in a market that has been rather exuberant, do you think that, investors should prepare themselves for a much deeper correction from here on?
Like I said earlier, see, if the fall is not more than, say, 800,000 points, I think we can see a decent bounce back. And the markets may stay possibly range bound. I mean, I really see a runaway rally from here because, I mean, unless the earnings which we see for Q3 is mind-boggling in the sense it's much beyond what we have been expecting. I mean, most of the sectors show double-digit growth. I mean, some of the sectors show about 25-30% growth. Only then we will see a sort of a runaway rally from here. And at the same time, we should also remember that, I mean, elections are due. And before elections, I mean, we've already had this sort of a rally. I don't think, I mean, before elections, we can have another major rally because elections means uncertainty, irrespective of, I mean, what we think as to who would come back. But I think that uncertainty will still play out. So, I mean, I really don't see a major up move from here. I mean, at best, we could stay where we are. I mean, after correcting, it can bounce back and stay where we are. But then in case the correction is more than about 1,500 points, I think that's what will unnerve most of the retail and the new HNIs who are coming to the markets in the last 1.5 to 2.5 years. Because most of them haven't seen a fall. I mean, for them, market goes only one way, and that is up. And any correction should be utilized to buy. I mean, that's exactly what they've seen. They made money doing that because of which the confidence level is very high. The liquidity flows are high. But somewhere, if it breaks the camel's back, I think that's when we will see the reality in the market. That is when we will see a further major correction. And that's when possibly you'll have the mid cap and the small caps coming back into those valuation zones, which are acceptable. I mean, historically acceptable,
All right. And, among the factors that will drive the markets, we also have interim budget on February 1. Do you think any major announcement will come out in the interim budget?
I don't think you can have any major announcement in the interim budget because typically it's actually a vote on account. Although we are calling that interim budget, and there were rumors that there could be some tinkering with personal taxation. We could have the exemption levels going up. I mean, if that happens, yes, I mean, it is surely sentimentally positive, but I don't think that alone will be enough to really drive the markets to new levels. And I doubt, normally we see, at least in the last 1 week, 10 days of January, we see some sort of like a move, which is a pre-budget rally. But this time I doubt whether that will be there because this is not a full-fledged budget.
All right. And, sir, you were talking about FII flows I want to touch on the Nifty Banking Index and the, on the price chart, the index has formed a triple bottom, which is a bearish signal. But from a fundamental standpoint, why are we seeing this sort of volatility? Time and again, the index is struggling around 48,000. We go up about 500 points, but the next session we gave up all the gains that we have made.
See, basically, I mean, I think all the good news is already factored in. I mean, you're talking of credit growth, that's factored in. NPS going down, that's factored in. I mean, we have seen the rate hikes, and because of which we have seen the NIMs going up. And in the last 1 or 2 quarters, most of the banks we have seen that the NIMs are topping out. So, I mean, the best is already factored in. What is not factored in, I mean, going ahead is that in case the growth slows down, because see, I mean, banks require deposits to increase the credit and advances which they give. And because the way the markets have moved, clearly the sort of deposits which were going, I mean, the savings which are going into bank deposits, I mean, that's gone down to an extent. And even the RBI governor has mentioned that we have had some of the big banking honchos really, I mean, talking about the slowdown in the deposit growth. I think that is what is going to hurt banks going ahead. And at the same time, we have seen that RBI also has been coming down quite sharply on the retail lending and the sort of evergreening which has been happening in that space. I think we will have more regulatory actions coming in for banks as well as NBFCs. So I think there'll be more of tightening. So looking at the sort of valuations which are there right now, the sort of a run-up which we have seen, some of the banks we have seen have become multi-baggers, especially PSUs. So I think the upside is quite limited from here, and any sort of further tightening, any sort of adverse news can actually see the banks correcting. I mean, for example, we have just seen Bank of Baroda correcting today because the headline numbers which have come were not really acceptable for the markets.
All right. And sir, India now has overtaken Taiwan and now ranks second right after China in the MSCI Emerging Market Index. Right. For the benefit of our viewers, can you explain to us what does it mean for Indian markets?
No, see, I mean, this is positive for the Indian markets, no doubt. I mean, the reason is that there are a number of funds which blindly follow the indices. I mean, some of them have benchmarks as indices, and some of them, I mean, they have a total portfolio which is exactly as per the indice. So, I mean, irrespective of what is there in the indice, they need to be buying those stocks. So, I mean, once we have the Indian stocks, I mean, having a higher weightage, clearly, I mean, these funds will have to straight away buy those stocks within a given time, and because of which, it's clearly a question of demand supply. When they start buying, and because of which those stocks or that sector moves up.
All right, and also wanted to shift your focus on the mutual fund industries. Now, some data came out. Mutual fund industry asset under management has crossed 50 lakh crore for the very first time in December. And even, just a couple of days back, we had a report which suggested that, we saw the highest number of demat account openings in December as well. But if we take a step back and look at, the overall participation, at least from Indian population, which currently stands at about 3%, whereas the world, compared to developed markets, the participation is somewhere around 40 to 50%. A long way to for us to go, right, sir?
No, I don't think anyone's really questioning that. I mean, we were at about 1.5% a couple of years back. From there, we have moved up, and you've seen the sort of liquidity base come into the market. And this is bound to happen going ahead because, I mean, more and more people are educated. When I talk of educated, I'm talking of financially educated. And the liquidity which has been lying in deposits have already started moving to the markets. But then, I mean, like once you have more and more people getting financially educated, more and more people are getting connected to the markets. Clearly, I think money would flow in here. So if you're talking of longer term, there's absolutely no question as to whether India as an economy will perform or Indian markets will perform. I mean, both these should. But then it cannot be a one-way street. And in between, there will be bloodbaths. You have to only ensure that you don't get butchered in those bloodbaths.
All right. So what should be the ideal strategy for investors, considering that there are a lot of binary events in the year to follow?
No, because see, I mean, when you're investing in the markets, I think you should be knowing where you're investing, which means you need to have I mean, have done some research, understand the stocks where you're investing in. Don't invest purely on tips just because someone is telling you that there's momentum in these stocks. Because right now, if you look around, there are so many of stocks which should have been penny stocks have moved multiple times. They seem like mid caps and the large caps, which actually is not the case. Because when the markets start falling, I mean, these just fall like nine pins. So one needs to be careful of not investing in stocks like those. Remain with the large cap blue chips or some of the larger mid caps where the story is good. So or possibly invest through mutual funds. I mean, don't invest directly if you don't have time to do research. So don't invest blindly in the markets because when the market falls, there's no one there to help you. I mean, you need to help yourself. And if you're not done research, then you're totally, I mean, in a dark alley.
All right. Keep the focus on research and invest, through mutual funds if you're not really sure where to put your money in. That's a view coming in from Mr. Amrish Balega. Thank you, sir. Thank you for joining us here on News9. Always a pleasure speaking to you.
Yeah, thank you.
But that's all we have in this edition of Last Tick. But stay tuned with us as we'll be right back with Business Plus on the other side.
Ram's Ayodhya rebuilt. Ram Lala's Pran Pratishtha. Countdown to January 22nd. Dateline Ayodhya. Catch the mega coverage only on News9 Live.